Just like manipulations are possible on the income statement, either in revenues or in expenses, what we are saying is some kind of manipulations are possible even on the cash flow statement. Though a cash flow statement is a reality kind of stuff, right? Real movement itself, there could be some manipulations associated with the cash flow statement. Again, it's not on the total cash flow, it's only the allocation between the various cash flows. Finally, because what the cash, whatever that comes out, should be there in my bank account. So there is no manipulation on the total value. But internally, because as I discussed earlier, majority of the analysts give a lot of focus to cash flow from operations itself, right? And because even if you see, we have talked about free cash flow to the firm and free cash flow to the equity computation, which were taking purely cash flow from operations as the base. So from an company evaluation standpoint, any analyst will focus more on cash flow from operations rather than the total cash flow. So because of this, what the companies are doing is they are trying to showcase cash flow from operations higher, probably reducing the cash flow from financing or cash flow from investment. They are adjusting there to show that cash flow from operations is much, much better. So probably free cash flow to the firm, free cash flow to equity, they are much higher, which is resulting in a value of the company to be much more positive. That is what is the typical manipulations that are happening. So the overall final cash is never manipulated, but what is actually manipulated is the internal elements of the cash part, right? So we'll see how they are getting scenarios. There are four types in which things are talked about here. The first mechanism is you stretch the accounts payable. Stretch the accounts payable means you don't pay to your vendors, or probably instead of a 30-day period, you take 60 days to pay to your vendors, or instead of paying to your vendor in this quarter, you pay in the next quarter. Because of that, what happens in this quarter, the account, I mean the cash is higher because the liability is increasing, which is resulting in a cash increasing. If you had paid that to your vendor, your cash would have gone down, but you have not paid to your vendor, suddenly showing that there is a lot of cash with you. Your cash flow wise, because the payment to the vendor is a cash outflow from operations. You are holding on to that. So the cash outflow from operations has gone down. So the total cash inflow is much more higher. So your final cash flow from operations is showing a higher value. This can work for one time, two times, three times, but it cannot work for a longer period. So because of this, what could very much happen is after some time, the suppliers can stop the additional credit